And Nuveen CEO, Jose Minaya. Nuveen manages more than $33 billion in ESG-focused strategies. So, Jose, you're a perfect person to ask about this claim that a lot of it is just nonsense. And it makes higher profits for asset managers like yours with higher fees, but that doesn't really address the problem.
Sure, and thank you for having me. Look, I think that narrative, and especially the term around greenwashing, it has been accelerating over the last several years, but you got to understand it's a byproduct of demand, right? As you mentioned, what we are seeing today is significant demand for ESG, labeled products. There's also been a different narrative, though, around clients, wanting to understand ESG risk factors better. How does it impact their returns or potentially even hurt their returns? Just about every inquiry we get from a new client today is asking us, for information around how do we deploy that? How do we look at these risks? What is our approach to ESG as a firm? So that, of course, is leading a lot of firms to go out there and make statements, whether you're an issuer or an asset manager, right? Trying to respond to that need for transparency and accountability from stakeholders, clients, and shareholders alike. And I think that's a good thing. It's a good thing that these things are popping up and they're being called out. It's a lot harder today, though, to do greenwashing, because what you're seeing is individuals like Tariq, and now you're also seeing consultants, whether it's a Morningstar that's rating managers and providing transparency on how they do this. You're seeing policymakers, regulators looking at this issue. So I think what you're seeing is a sophistication in the industry and bringing this more to light. And I think it's needed because there's a lot of acronyms, whether it's ESG, responsible investing. There's a lot more that we need to bring in terms of consistency and what it is and what it's not. Because for Nuveen, I could tell you, we would never claim to own the cleanest companies on the planet, but we do claim to try to drive and understand those risks and drive engagement and transparency.
So you mentioned the regulators. The SEC does have a new task force devoted to looking at ESG disclosures and transparency there and make sure that the commitments are followed up and are not misleading. Do you expect that to work? What do you think is going to be the result of that?
I think this is the process of any industry and kind of the maturity of it, right? As, again, what's driving this today is demand, right? And it's there. And one, it's also people not just, it used to be that narrative of, I'll get lower returns, higher fees, I just don't want to invest in sin stocks. Today is people can look out the windows and see forest fires, natural disasters, and these things are impacting portfolios. It's driving demand. So policymakers are waking up to this. The flows are coming in. And there is a lack of transparency. So what I do believe is that combination of, as asset managers, what we do is manage risk. That's our job, and it's our fiduciary duty to optimize returns. Where policymakers can come in and regulators is helping drive consistent standards, have the right language and transparency so that we can all play in a better level playing field.
Jose, as you look at the decade ahead for your broad industry, what do you think will see the largest inflows? Individual stock trading by retail investors or others, actively managed funds that maybe command a 1% or higher price, or ETFs?
I think you'll continue to see a trend towards kind of active to passive. Now, I will say that the next 10 years will probably be lower. There'll be more volatility, lower rates. So I think you will see active managers kind of do better than they have done in the past. But it's going to be around more outcome-driven solutions, right? Clients, they are no longer asking a question around, do I buy this particular bond or this particular stock? They're looking for outcomes, right? So how that plays into the mix, and they're looking for things that drive alpha, right? So I think you are going to see increased flows in ESG. You're going to see more increased flows in alternatives and less liquid vehicles, because today it's very hard to hit your targeted returns in your traditional 70-30 or 60-40 type of portfolio. They're going to be looking for better correlation. They're going to be looking for better income, because I do think over the next 10 years, you're going to live with more volatility. You're going to live with lower returns. And there's going to be a lot more uncertainty in the markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.